Atlas has expanded its multi-currency banking product by integrating stablecoin accounts, a move that enhances its offerings for businesses and private wealth structures to manage digital assets. This new feature supports a multi-coin, multi-chain approach, connecting users to 200 stablecoin issuers across more than 50 blockchains, as noted by Atlas Head of Product, James Robertson. The integration allows account holders to transact in stablecoins, move seamlessly between different blockchains and currencies, and convert into over 26 fiat currencies. Moreover, the product offers the opportunity to earn yields on stablecoin balances, with funds held in a one-to-one reserve that is verifiable on-chain, ensuring transparency and security. This development is part of a broader trend where stablecoins are increasingly being integrated into mainstream financial activities, such as B2B payments and treasury management, marking their evolution from merely crypto exchange tools to integral components of financial infrastructure. The shift signifies a growing acceptance and potential for stablecoins to drive efficiencies in financial operations. In related news, OKX and Circle Internet Group have partnered to facilitate easy conversion between US dollars and USDC stablecoins, while BNY Mellon has been chosen by Ripple for the custody of its stablecoin reserves, underscoring the institutional adoption of digital assets. These moves collectively highlight the financial sector's pivot towards embracing digital currencies and blockchain technology as part of their strategic operations.
Wolfspeed Inc., Wolf, is experiencing a notable uptick in its stock price, driven by strategic restructuring efforts aimed at significantly reducing its debt burden. The company's recent pre-packaged Chapter 11 filing is designed to eliminate approximately $4.6 billion in debt, equating to a 70% reduction, and intends to cut annual cash interest payments by 60%. These measures are anticipated to expedite Wolfspeed's journey towards profitability, bolstering investor confidence and contributing to the recent rally in its stock price. The appointment of Gregor van Issum as the new Executive Vice President and Chief Financial Officer, effective September 1st, has further fueled optimism. Van Issum brings extensive experience from the semiconductor industry, which is expected to be instrumental in steering Wolfspeed through its restructuring phase. The market's positive response is reflected in Wolfspeed's stock performance, with shares rising by 7.89% to $1.43 as of Monday morning. Despite this increase, the stock remains significantly lower than its 52-week high of $25.20. Wolfspeed's restructuring process, expected to conclude by the end of the third quarter, aims to maintain regular operations and customer deliveries throughout. This strategic overhaul is part of Wolfspeed's broader effort to strengthen its capital structure and position itself more favorably within the information technology sector. Investors interested in gaining exposure to Wolfspeed's potential growth may consider purchasing shares directly or through sector-focused ETFs that include the company in their holdings.
The European Commission has proposed a new floating price cap on Russian oil, set at 15% below the average global crude market price over the preceding 3 months. This initiative aims to tighten the financial constraints on Russia amid ongoing geopolitical tensions, particularly related to the conflict in Ukraine. The current cap, established by the Group of 7 G7 nations at $60 per barrel, has become less effective due to fluctuations in oil futures. The proposal for a dynamic cap comes as Brent crude prices have recently stabilized around $70.36 per barrel, making the existing cap less impactful. The new mechanism would adjust quarterly, reflecting market conditions more accurately. This move is part of the EU's broader strategy to limit Russia's revenue from oil exports, which are crucial for funding its government and military activities. The proposal requires unanimous agreement from EU member states to be implemented, indicating potential challenges in reaching a consensus. Despite the EU's push, the United States has not expressed support for lowering the cap, leading Europe to proceed independently. The proposal also addresses concerns from EU maritime states like Malta, Greece, and Cyprus, which are key players in shipping and insurance industries, affected by such regulations. The Kremlin has indicated it is prepared to manage the implications of this potential new cap, suggesting a complex geopolitical and economic landscape ahead.
HCL Technologies Limited, India's third-largest IT services company, reported a strong start to the fiscal year with better-than-expected revenue for the June quarter, amounting to $3.55 billion. This performance surpassed the forecasts of 37 analysts polled by Bloomberg and marked the company's best first quarter in 6 years. HCLTech's growth was primarily driven by its European operations, which contributed significantly to its incremental business. The company revised its full-year revenue growth forecast to 3 to 5%, up from a previous range of 2 to 5%. Despite this positive revenue outlook, HCLTech's management lowered its full-year profitability guidance by 100 basis points, which has raised concerns among investors. The company's net profit for the quarter fell 9.3% sequentially to $450 million, marking the second consecutive quarter of profit decline. Operating margins declined by 160 basis points to 16.9%, and the company adjusted its full-year operating margin target to 17 to 18%, down from 18 to 19% previously. This margin pressure was attributed to factors such as specialized hiring, skill and location mismatches, and a one-off customer bankruptcy. Additionally, HCLTech software products business, typically a margin booster, saw a 190 basis point decline in operating margins. The company also reduced its headcount by 269 employees, in contrast to its peer Tata Consultancy Services, TCS, which added over 5,000 employees in the same period. Despite these challenges, HCLTech remains optimistic about meeting its revised guidance, supported by strong revenue growth and positive booking expectations.
The recent financial analysis contrasts BRC Inc., NYSE BRCC, and Warby Parker, NYSE WRBY, both consumer staples companies, assessing them on various financial metrics such as dividends, institutional ownership, risk, profitability, and valuation. BRC, a company involved in the coffee industry and supporting military personnel, appears to have a more favorable analyst outlook with a consensus target price suggesting an 88.52% potential upside. In contrast, Warby Parker, an eyewear retailer, shows a potential downside of 2.68%. Despite Warby Parker's higher revenue, BRC exhibits better earnings performance, although both companies currently operate at a loss. Institutional and insider ownership patterns reveal that Warby Parker is significantly backed by institutional investors, owning 93.2% of its shares, compared to BRC's 16.3%. However, BRC has a higher insider ownership at 69%, indicating strong internal confidence in the company's future. In terms of risk, BRC presents lower volatility with a beta of 0.9 compared to Warby Parker's beta of 2.09, suggesting that Warby Parker's stock is more susceptible to market fluctuations. Overall, BRC outperforms Warby Parker in several key areas, making it a more attractive option for investors seeking growth potential amidst current market conditions.
GE Vernova Inc. has agreed to pay $10.5 million to the town of Nantucket, Massachusetts, following an incident where one of its offshore wind turbine blades broke and washed ashore last year. This settlement aims to compensate local businesses for cleanup costs, lost rental income, and other damages. The incident had caused significant concern among the affluent island community, highlighting the potential environmental risks associated with offshore wind energy. Despite this setback, GE Vernova has seen its shares rise over 200% since last July, largely due to increased demand for its gas turbines, driven by the energy needs of AI data centers. The settlement agreement also involves Vineyard Wind LLC, a joint venture between Avangrid Inc. and Copenhagen Infrastructure Partners PS, which was released from future claims related to the incident. However, the agreement does not shield the companies from potential lawsuits if similar turbine issues arise in the future. The event underscores the ongoing challenges faced by the offshore wind industry, including high interest rates, supply chain disruptions, and political opposition. Nonetheless, GE Vernova's financial performance indicates resilience and adaptability as it continues to capitalize on the growing energy demands in the technology sector.
Massachusetts Financial Services Co. MA has significantly reduced its stake in the Goldman Sachs Group, Inc., NYSE, GS, by 28.9% during the first quarter, as revealed in a recent SEC filing. This reduction involved the sale of 756,876 shares, leaving the fund with 1,859,000 shares valued at over $1 billion. Despite this sizable divestment, institutional investors and hedge funds continue to hold a majority of Goldman Sachs stock, accounting for 71.21% of the total shares. The stock opened at $704.11, with a 52-week range between $437.37 and $726, suggesting a robust performance in the market. Goldman Sachs recently reported strong quarterly earnings, with an EPS of $14.12, surpassing analyst expectations of $12.57 on revenues of $15.06 billion. This performance is indicative of the firm's solid return on equity of 13.76% and a net margin of 11.86%. Despite these positive results, some financial analysts have downgraded their ratings on the stock, with Daiwa Capital Markets and HSBC adjusting their outlooks to neutral and moderate sell, respectively. The consensus rating remains hold, with a target price of $614, reflecting mixed sentiment regarding Goldman Sachs' future prospects amidst a competitive financial services landscape.
Pakistan and the United Kingdom have announced the formation of a new Business Advisory Council to enhance trade relations, a significant outcome of the first UK-Pakistan trade dialogue held in London. This initiative, co-chaired by UK Minister for Trade Policy and Economic Security, Douglas Alexander, and Pakistan's Commerce Minister, Jam Kamal Khan, aims to provide strategic policy recommendations, create a confidential forum for discussion, and address market access challenges. The council will include senior business leaders and government officials from both nations, focusing on sectors like healthcare and digital technology, which are pivotal to the UK's industrial strategy. The UK remains a critical trading partner for Pakistan, being its largest in Europe and third largest globally, with bilateral trade reaching £4.7 billion in 2024, a 7.3% increase from the previous year. This initiative comes at a crucial time for Pakistan, which is working to stabilize its economy and attract foreign investment following financial instability. The UK has pledged up to £200,000 in technical assistance to support Pakistan's investment outreach, reinforcing its commitment to strengthening bilateral economic ties. The dialogue sets a foundation for a more structured trade partnership, aiming to expand trade, attract investment, and create long-term economic opportunities for both nations.
The S&P/TSX Composite Index, Canada's main stock index, reached a record high, driven by gains in the industrial and technology sectors, closing at 27,198.85 points. This surge reflects robust sector performance, potentially indicating investor confidence in the economic outlook and growth prospects of these industries. In the U.S., the markets also experienced upward movement, with the Dow Jones Industrial Average closing at 44,459.65, the S&P 500 at 6,268.56, and the Nasdaq Composite at 20,640.33, suggesting a broadly positive sentiment across North American markets. Despite the stock market gains, commodity prices showed a decline, with the August crude oil contract falling to $66.98 per barrel, and the August gold contract decreasing to $3,359.10 an ounce. These price movements could reflect shifting investor preferences or reactions to global economic indicators, such as changes in demand forecasts or geopolitical developments. Meanwhile, the Canadian dollar saw a slight dip, trading at 73.03 cents US, which might be influenced by these commodity price trends or broader currency market dynamics. Overall, the mixed signals in commodities versus equities highlight the complex interplay of market forces currently at play.
Dell Technologies, NYSE Dell, and Lenovo Group, OTC/MKTS, LNVGY, have been critically analyzed to determine their investment potential. Dell Technologies emerges as the more favorable investment, scoring higher on 15 out of 17 factors compared to Lenovo. Dell's stock exhibits slightly higher volatility with a beta of 1.02 compared to Lenovo's beta of 0.77, indicating Dell is more sensitive to market movements. Analysts have given Dell a stronger consensus rating with a target price suggesting an 8.75% upside, while Lenovo has not received any notable analyst ratings. Institutional ownership is significantly higher for Dell, with 76.4% of its shares held by institutions, suggesting strong confidence in its long-term performance. In terms of profitability, Dell outperforms Lenovo with higher revenue and earnings, although Lenovo trades at a more attractive price-to-earnings ratio, indicating relative affordability. Both companies offer dividends, but Lenovo's yield is notably higher at 6.1%, compared to Dell's 1.7%. However, Dell has consistently raised its dividends for 3 years, reflecting a commitment to returning value to shareholders. This analysis positions Dell Technologies as a more robust investment choice, driven by its stronger financial metrics and institutional backing.